Forex Market Outlook, July 2025. Overview. Global FX markets are currently driven by trade war uncertainty and diverging central bank paths. The U.S. dollar has weakened year-to-date amid concerns that tariff conflicts will slow growth, while other majors, such as the euro, pound, and commodity-linked currencies, have mostly strengthened. In Europe, the ECB has cut rates to 2% and signaled a possible pause, with inflation returning near its 2% target. Meanwhile, the Bank of Japan and other safe haven markets have held policy steady, downplaying the need for hikes this year. Market sentiment remains broadly risk-on, with the yen and Swiss franc weakening as equity indexes continue to rally. Central bank policy, trade developments, and economic data will be the key FX drivers for the month ahead. Euro to U.S. dollar. The euro has rallied strongly against the dollar. Following the ECB's June rate cut, President Lagarde hinted that easing is nearing its end. Euro to U.S. dollar briefly hit $1.1495, a 6-week high and close to a 3-year high, as markets price in an ECB pause. U.S. dollar weakness, driven by softer economic data and ongoing trade worries, has helped fuel this move. Seasonally, June tends to be bullish for euro to U.S. dollar. Technically, the pair is testing a critical resistance zone around 1.1450. A decisive weekly close above this could open upside toward 1.16. Additionally, strong demand for USD puts in the options market suggests further downside pressure on the greenback. Overall, the euro outlook is cautiously bullish. U.S. dollar to Japanese yen. The yen has weakened in recent weeks as U.S. yields rose and risk sentiment improved. After the BOJ left policy unchanged and cut GDP forecasts, Japanese long-term bond yields fell sharply, lifting U.S. dollar to Japanese yen to around 144.3. The pair touched a 4-week high near 145.5 following those developments. However, recent commentary from BOJ officials suggests no further rate hikes are expected this year due to trade-related uncertainties. Technically, U.S. dollar to Japanese yen faces resistance between 144.50 and 145.00, with a breakout possibly targeting 148.5. Support lies around 142.50. Seasonally, June is mildly bearish for the pair. Sentiment remains mixed, but the pair may remain range-bound. A dip toward 142 could occur on risk aversion, while renewed optimism could push the pair above 145. Pound sterling to U.S. dollar. Sterling remains one of 2025's top-performing majors against the dollar, up roughly 8% year-to-date. The rally has been supported by strong UK data and successful trade agreements, including a UK-US deal. The pound recently hit 3-year highs around 1.3590. While the dollar's weakness has contributed, the Bank of England is expected to cut rates later this month, which could cap further upside. Policymakers have warned of growth risks stemming from U.S. tariffs. Technically, pound sterling to U.S. dollar is in a strong uptrend above all major moving averages. Resistance lies near 1.36, with the next targets at 1.37 or 1.38 if the rally continues. However, June has historically been a weak month for the pound, and any Fed/BOE policy divergence could reverse gains. Traders may consider buying on dips, but should remain cautious of potential dollar rebounds. Commodity currencies. Australian dollar to U.S. dollar. The Australian dollar remains under pressure from repeated RBA rate cuts. The latest cut in May brought the cash rate to 3.85%, with further easing likely. Weak Q1 GDP and sluggish demand from China have dampened support. Technically, Australian dollar to U.S. dollar has been consolidating below 0.6513. A weekly close above this level could open further upside, especially if trade optimism lifts risk appetite. On the downside, another RBA cut or weak Chinese data could push the pair toward 0.62. Seasonals offer a slight edge in June, suggesting some upside potential if markets remain risk-on. NZD/USD. The Kiwi dollar followed a similar path, with the RBNZ cutting rates to 3.25% and warning of ongoing trade risks. Although there was a brief rally, broader headwinds remain. If global risk sentiment stays strong, NZD may benefit as a high-yielding currency. However, aggressive easing has already weakened the outlook. US dollar to Canadian dollar. The Canadian dollar is grappling with trade war fallout. The BOC held rates at 2.75% but cited tariffs as a key downside risk. Recently, the U.S. doubled tariffs on Canadian metals. U.S. dollar to Canadian dollar has traded near 1.3698 and is likely to stay range-bound between 1.36 and 1.40 unless a major catalyst emerges. Oil prices will also play a significant role in CAD direction. Risk-on markets may favor CAD strength. Otherwise, downside risks persist. Safe haven currencies. U.S. dollar to Swiss franc. The Swiss franc has benefited from safe haven demand. Despite this, the pair trades near oversold levels technically, and the S&B may be uncomfortable with excessive CHF strength. A rebound in U.S. dollar to Swiss franc could materialize if the dollar recovers or if the S&B intervenes. A resurgence in risk-off sentiment could still push CHF and JPY higher, so traders should monitor equity and trade developments closely. Technical and sentiment overview. Sentiment indicators show heavy USD put positioning, reflecting broad bearish sentiment on the greenback. Risk appetite remains elevated, shown by falling volatility and equity gains. Momentum signals favor the euro and pound in the near term, while safe havens underperform. Seasonally, June tends to be bullish for euro to US dollar and Australian dollar to US dollar, neutral to bearish for US dollar to Japanese yen, and bearish for pound sterling to US dollar. These trends can provide secondary confirmation for trading strategies. Economic calendar highlights. U.S. non-farm payrolls and CPI reports. FOMC policy meeting, June 14th to 15th. Bank of England policy decision, June 19th. Ongoing trade policy headlines. These events could drive short-term volatility and confirm or challenge the broader directional trends outlined above.